This section covers important considerations related to federal tax implications for life insurance and annuities. Here's a summary of the key points. Federal tax considerations for life insurance. This section explains the taxation of policy benefits, dividends, and loans for life insurance and annuities. Key terms to know include FIFO, LIFO, policy endowment, policy proceeds, pretax contribution, surrender, tax-deductible, taxable, and tax-deferred. Taxation of life insurance policies. Premiums are not tax-deductible. Death benefits are tax-free when taken as a lump sum, and interest is taxable when paid in installments. Dividends are not considered income for tax purposes, but the interest earned on them is subject to taxation. Cash value accumulations in a policy can be borrowed against, and any excess cash value over premiums paid is taxable as ordinary income upon surrender. Policy loans are not income taxable, but the insurance company charges interest on them. Surrendering a policy for cash value may result in taxation if the surrender value exceeds the premiums paid. Cash value accumulations. Cash values in a policy grow tax-deferred and can be borrowed against. Excess cash value over premiums paid is taxable as ordinary income upon surrender. Policy loans are not considered income taxable. Amounts received by beneficiary. Lump sum life insurance proceeds paid to a named beneficiary are generally tax-free. Settlement options, which include both principal and interest payments, result in taxable interest income. Taxation of non-qualified annuities. Annuity benefit payments consist of taxable interest and non-taxable principal, cost base. Withdrawals during the accumulation phase are taxed on a LIFO basis, with interest taxed first. Accelerated benefits are tax-free for terminally ill insured individuals and partially tax-free for chronically ill individuals. Modified endowment contracts, MECs. Endowment policies may have premiums exceeding the required amount to fund the death benefit. The IRS uses the 7-pay test to determine if a policy is overfunded and classifies it as a MEC. MECs lose standard tax benefits but retain tax-free death benefits. Taxation of MEC cash value includes tax-deferred accumulations, taxable distributions, withdrawals and policy loans, on a LIFO basis, and a 10% penalty for premature distributions. Chapter Recap. The chapter reviews tax considerations for life insurance and annuities, highlighting taxable, tax-deductible, and tax-free features and transactions. This information provides a comprehensive overview of federal tax considerations in the context of life insurance and annuities. 5-part considerations. Federal tax considerations for life insurance. This section will help broaden your knowledge of life insurance and annuities by explaining the subject of taxation. You will learn the basic principles of taxation of policy benefits, dividends, and loans, as well as options available for non-taxable exchanges. Terms to know: FIFO, first in, first out, principle under which it is assumed that the funds paid into the policy first will be paid out first. LIFO, last in, first out, principle applied to asset management in life insurance products, under which it is assumed that the funds paid into the policy last will be paid out first. Policy endowment. Maturity date policy proceeds. In life insurance, the death benefit pretax contribution made before federal and/or state taxes are deducted from earnings. Surrender. Early termination of a policy by the policy owner. Tax-deductible. A reduction of taxable income, resulting in lower tax liability. Taxable. Subject to taxation, payable to state and federal government. Tax-deferred. Taxes on investments or gains, such as interest or dividends, are paid at a future date instead of in the period in which they are incurred. Taxation of life insurance and annuities. Generally speaking, the following taxation rules apply to life insurance policies. Premiums are not tax-deductible, and death benefit tax-free if taken as a lump sum distribution to a named beneficiary, and principal is tax-free. Interest is taxable if paid in installments, other than lump sum. 1. Amounts available to policy owners. As you have already learned, permanent life insurance provides living benefits. There are several ways in which policy owners may receive those living benefits from the policy. Dividends. Since dividends are a return of unused premiums, they are not considered income for tax purposes. When dividends are left with the insurer to accumulate interest, the interest earned on the dividend account is subject to taxation as ordinary income each year interest is earned, whether or not the interest is paid out to the policy owner. Cash value accumulations. Any cash value accumulations in the policy can be borrowed against by the policy owner, or may be paid to the policy owner upon surrender of the policy. Cash values grow tax-deferred. Upon surrender or endowment, any cash value in excess of cost basis, premium payments, is taxable as ordinary income. Upon death, the face amount is paid, and there is no more cash value. Death benefits generally are paid to the beneficiary income tax-free. Policy loans. The policy owner may borrow against the policy's cash value. Money borrowed against the cash value is not income taxable. However, the insurance company charges interest on outstanding policy loans. Policy loans, with interest, can be repaid in any of the following ways: by the owner while the policy is in force, at policy surrender or maturity, subtracted from the cash value, or at the insured's death, subtracted from the death benefit. Know this: policy loans from the cash value are not income taxable. Surrenders. When a policy owner surrenders a policy for cash value, some of the cash value received may be taxable as income if the cash surrender value exceeds the amount of the premiums paid for the policy. When the owner withdraws cash value from a universal life policy, partial surrender, both the cash value and the death benefit are reduced by the surrender. Example: consider the following scenario. Face amount: $300,000 premiums paid, $70,000 total cash value, $100,000 if the insured surrendered $30,000 of cash value. The full $30,000 would be income tax-free. If the insured took out $100,000, the last $30,000 would be taxable because the $100,000 exceeds the premiums that were paid in by $30,000. Accelerated benefits. When accelerated benefits are paid under a life insurance policy to a terminally ill insured, the benefits are received tax-free. When accelerated benefits are paid to a chronically ill insured, for example, someone who has cancer, Alzheimer's disease or other severe illness, these benefits are tax-free up to a certain limit. Any amount received in excess of this dollar limit must be included in the insured's gross income. 2. Amounts received by beneficiary. General rule and exceptions. 3/5 life insurance proceeds paid to a named beneficiary are generally free of federal income taxation if taken as a lump sum. An exception to this rule would apply if the benefit payment results from a transfer for value, meaning the life insurance policy is sold to another party prior to the insured's death. Know this: lump sum cash payment of life policy proceeds are tax-free for the beneficiary. Settlement options. With settlement options, when the beneficiary receives payments consisting of both principal and interest, the interest portion of the payments received is taxable as income. For example, if $100,000 of life insurance proceeds were used in a settlement option paying $13,000 per year for 10 years, $10,000 per year would be income tax-free and $3,000 per year would be income taxable. Know this: in settlement options, the principal is tax-free, but the interest is taxable. Permanent life features tax treatment. Premiums not tax-deductible. Cash value exceeding premiums paid taxable at surrender. Policy loans not income taxable. Policy dividends not taxable. Dividend interest taxable in the year earned. Lump sum death benefit not income taxable. Know this: taxes must be paid either upon contribution or upon distribution, not both. If taxed on one end, will not be taxed on the other. 3. Taxation of non-qualified annuities. A portion of each annuity benefit payment is taxable, and a portion is not. The portion that is non-taxable is the anticipated return of the principal paid in. This is known as the cost base. The portion that is taxable is the interest earned on the principal. This is known as the tax base. Accumulation phase withdrawal. When money is withdrawn from the annuity during the accumulation phase, the amounts are taxed on a last in, first out basis, LIFO. Therefore, all withdrawals will be taxable until the owner's cost basis is reached. After all of the interest is received and taxed, the principal will be received with no additional tax consequences. Tax considerations for life insurance and annuities: premiums not deductible, personal expense. Death benefit not income taxable, except for interest. Cash value increases not taxable, as long as policy in force. Cash value gains taxed at surrender. 4/5 dividends not taxable, return of unused premium. However, interest is taxable. Accumulations interest taxable, policy loans not income taxable, surrenders surrender value past premium equals amount taxable, partial surrenders first in, first out, FIFO. Settlement options death benefits spread evenly over income period, averaged. Interest payments in excess of death benefit portion are taxable. Estate tax: if the insured owns the policy, it will be included for estate tax purposes. If the policy is given away, possibly to a trust, and the insured dies within 3 years of the gift, the death benefit will be included in the estate. FIFO method applies to life insurance only. The policy owner will receive their investment in the contract first before receiving any gains in the policy, or being taxed on those gains. Annuities follow a LIFO, last in, first out, format. The modified endowment contracts, MECs. Generally speaking, an endowment policy is an investment instrument. Endowment life insurance policies promise to pay the face amount if the insured survives until the end of a specified period, e.g., 20 years, 30 years, or until the insured's age 65, and if the insured dies within the same specified period. Endowments require premiums far in excess of the amount required to fund the death benefit. Following the elimination of many traditional tax shelters by the Tax Reform Act of 1984, single premium life insurance remained as one of the few financial products offering significant tax advantages. Consequently, many of these types of policies were purchased solely for the purpose of setting aside large sums of money for the tax-deferred growth as well as tax-free cash flow available via policy loans and partial surrenders. To curtail this activity, and to determine if an insurance policy is overfunded, the Internal Revenue Service, IRS, established what is known as the 7-pay test. Any life insurance policy that fails a 7-pay test is classified as a modified endowment contract, MEC, and loses the standard tax benefits of a life insurance contract. In a MEC, the cumulative premiums paid during the first 7 years of the policy exceed the total amount of net level premiums that would be required to pay the policy up using guaranteed mortality costs and interest. Once a policy fails the 7-pay test and becomes a MEC, it remains a MEC. Know this. A MEC is an overfunded life insurance policy equals failed the 7-pay test. Know this. Once a MEC, always a MEC. All life insurance policies are subject to the 7-pay test, and any time there is a material change to a policy, such as an increase in the death benefit, a new 7-pay test is required. Whether from a life insurance policy or a MEC, the death benefit received by the beneficiary is tax-free. The following are taxation rules that apply to MEC's cash value. 5/5 tax-deferred accumulations. Any distributions are taxable, including withdrawals and policy loans. Distributions are taxed on LIFO basis, last in, first out, known as interest first rule. And distributions before age 59.5 are subject to a 10% penalty. See Chapter Recap. This chapter explained the basic taxation principles for life insurance and annuities. Let's recap the taxable, tax-deductible and tax-free features and transactions. Taxation: life insurance premiums not tax-deductible. Cash value taxable only if the amount exceeds premiums, taxed on gain. Policy loans not taxable. Interest not tax-deductible. Dividends not taxable as return of premium. Any interest is taxable. Accelerated benefits: tax-free death benefit not taxable if lump sum. Any interest is taxable. Surrenders taxable if the cash surrender value exceeds the amount of the premium paid. Annuities: accumulation tax deferred in individual annuities, not tax deferred in corporate-owned withdrawal of principal and interest last in, first out basis. Lump sum cash surrenders taxable. Premature distribution tax and 10% penalty. Distributions at death: interest taxable. Other related concepts: modified endowment contract, MEC, overfunded life insurance policy, 7-pay test. Accumulation tax deferred distributions taxable last in, first out. Distributions before age 59.5 10% penalty. Thanks for watching.